We've got these turnover ratios, also known as efficiency ratios. How quickly can you turn over your business? And we saw seeing these again. I mean, we're seeing these multiple times. I'm not going to lie. You need to memorize these. You got to get these down. Also known as efficiency ratios. How efficient is your entity, company at its operations? Specifically taking a look at the accounts receivable turnover ratio, just because it's more tested, more asked about. And let's see some situations involving it. As I mentioned, think of the journal entries. And in this case, think of the journal entry made for a sale. That's going to be a debit to accounts receivable and a credit to sales. Now, an increased ratio here, meaning we have higher sales and consistent or lower average accounts receivable, or maybe consistent sales and lower average accounts receivable. This could mean that a company is collecting its accounts receivable more aggressively, thus lowering its average accounts receivable, and its customers are paying their bills more consistently. So that's good. That's a positive indicator. Now, a decreased ratio, which would mean that sales are going down, or maybe sales are staying the same and the average accounts receivable are going up. That could mean that fictitious sales being recorded throughout the year as sales and AR should increase together. You could read into this and potentially look for any issues. There could be an incorrect cutoff of sales at the end of the year because, well, sales should go up consistent to AR. So if there is any variance in it, like we've talked about many times, discover the variance, understand what's going on, ask management, and then corroborate management's explanation. Maybe management doesn't really know for sure, and you got to go out there and do some testing of other accounts, right? You got to make these connections throughout the entire financial statements. Obviously, if I could tell you with which process to take the exam, say take the financial section first, because you got to understand the financial statements in order to audit them. But here we are. We're going to do well with this regardless of where you are. Lastly here, a decreased ratio could indicate that a company is having difficulty collecting its receivables or that its customers are paying their bills more slowly. And that's either way, that's just not beneficial for the company. Talking about the inventory turnover ratio as well, some things we can assess and take away here. How a company effectively uses its assets, also known as inventory. Inventory is an asset. Now, an increased inventory turnover ratio could indicate that a company is selling more of its inventory and therefore generating more revenue. Okay, very good point, because as revenue goes up, cost of goods sold will probably go up. Now, an increased inventory turnover ratio could also indicate that a company is selling its inventory at a faster rate than a company with a decreased inventory turnover ratio. All just important points to keep in mind. Assessing this as the auditor, you need to have these critical thinking connections. We've got examples here. Let's see some examples for our turnover ratios. What are our accounts payable turnover and days of payables outstanding ratios? Well, we need to use them both in conjunction with each other. We are going to say that the AP turnover ratio is the cost of goods sold divided by the average accounts payable. And we're just going to kind of plug that in here. We have cost of goods sold of 400. We're going to add together the beginning and the ending AP, divided by 2 to get the average. That gives us our AP turnover of 10. Now, for the days of payables outstanding, that formula is ending accounts payable divided by cost of goods sold divided by 365. Assume it's 365, but the question will actually tell you if it's either going to be 360 or 365. They're not going to do anything funky. Now, what is our ending? It is going to be 50,000, as mentioned, divided by cost of goods sold, which is 400,000, divided by 365. That's going to get us to a final answer of 45.62, which means that in general, the process is which it takes us 45.62 days to pay our bills. Now, is that good? Is it bad? I mean, it's better the longer it is, right? Because we can keep our cash on hand. However, maybe those vendors who we have to pay are not going to be too thrilled with us. However, this isn't too terrible. This is probably more of a normal one, but this is where you compare this to any competitors or the industry average. Receivable turnover ratio, take a look. Obviously, make notes. Try to do your best to memorize and understand all of these, and again, comparing them to other companies and prior years. Let's see an example here, quite similar to what we saw prior. We've got sales, cost of goods sold, same amounts here. Our accounts receivable turnover ratio. Now, if you want to just make notes of these, practice them, whatever, I think that's definitely a great way to get these down. The accounts receivable turnover ratio, this is the number of times per year typically that a company is converting its receivables into cash. The days sales and accounts receivable, that's how many days on average it takes a company to convert its credit sales into cash. You want that to be as low as possible to be able to collect that cash. So take a look. I'll give these a shot. Again, not too difficult. It's the understanding of them which gets difficult. So I want you to have the math down in order to be able to critically think. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.